I think one of the first things that needs to be discussed is the differences between open-end funds and closed-end funds. And when I say closed-end funds, I don't mean closed funds, I mean closed-end funds. Open-end funds basically have some mechanism for redemption. Closed-end funds do not have a mechanism for redemption. When you're investing in certain types of investable securities or other assets, you may need to choose from the perspective of the company that's doing the investing whether the fund will be open or closed at a very early stage. Certain things such as real estate are very illiquid and may not be situations where you want to have an open-end redeemable fund, because even if you gate and put down the ability for people to redeem, you still can't gate forever. And what happens is that basically you have a liquidity mismatch between sort of what you've sold to the investor and their ability to redeem and your underlying asset and the ability to actually sort of liquidate that. For instance, if you were to enter into a situation where you've invested in a real estate market and the market goes through a slump for 2 or 3 years, it could be very difficult, if not impossible, at any normal valuation to exit that building. How do you redeem investors? Because of this liquidity mismatch, people usually choose different types of funds. Open-end funds, closed-end funds. Closed-end funds fit for much more, I would say, PE-style investments, VC-style investments, real estate-style investments that have long maturities and basically are at the end of the maturities that are then sold off in a very sort of staid fashion. Open-end funds tend to be much more liquid. So for instance, stocks, commodities, other things like that. Obviously, when you're talking about an open-end investment company, you're not talking about anything relating to closed-end funds. So closed-end funds and the entire ecosystem that surrounds them, PE, VC, real estate, they won't be impacted by this in any way, shape, or form. Because these are not closed-end funds. These are open-end funds. They have to have a redeemable. Open-end funds tend to be the ones that we talk about when we talk about management offshore of a lot of money. Those end up being sort of in your Cayman or your BVI portfolios, whether it be a Cayman portfolio company or a BVI company. The point of those tends to be that when you have an offshore open-end fund, there's some redemption capability. You can put gating down if you need to sort of slow it for a short period of time, but you can't gate forever. And in the process of having that open-end fund, you are investing in liquid securities, liquid assets that allow you to raise and lower the actual sort of underlying investments while you're redeeming or bringing in new investors. Your open-end investment scheme is meant to sort of deal with that, but in Singapore. Now, having said that, people are very comfortable with the offshore schemes. The one thing that investors really like, and we're talking about allocators that allocate billions, not people who are allocating a few hundred million, is that they like to understand the resolution schemes in relation to the legal resolution schemes. They also like to understand the structures that are going to be done and how they're going to control and understand and work on those structures. They are very, very comfortable with Cayman. They're very, very comfortable with BVI. They are very, very uncomfortable with Singapore because they've never seen a Singapore structure. And as a consequence, they're always going to ask questions. How does it get resolved in the courts? We understand the Singapore courts are very good courts, but do they have 20 years of litigation about these issues to back themselves up? Do we know how it will be resolved in this situation because it's already been resolved 3 other times by the local courts? That is a very big question for investors. And when you're dealing with billions of dollars, that sort of risk of having that extra, 50 basis points is something that you may want to avoid by still keeping your Cayman and BVI structure. So it's going to be very difficult in the short term to move from offshore to onshore for these open-end funds. Having said that, this is predominantly a mutual fund type of scheme, which is basically probably going to be offered to more retail investors. And that's very different than your private investor sort of scheme. So there will be some motion in that direction. We will see a lot of the old trusts get abandoned. It is more cost effective to run these. That will actually incentivize the managers to move in that direction. I do see an uptake in sort of the actual use of these vehicles once they become available, depending upon the regulatory scheme that comes up. Lord forbid we see something that doesn't work very well. But if we do see something that is in line with what would be considered to be normal structures of sort of what the UK structure has, I do see some sort of value to this. It's going to be difficult to chip away at the advantage that the offshores have still.